Hey guys, it's Sasha. The valuation of Palantir has just crossed $250 billion after the stock has gone up 50% in the first month this year, on the back of already going up 400% in 2024 and another 150% in 2023. In the last 2 years, Palantir has gone up over 1,600%. And in pre-market trading this morning, Palantir's price to equity ratio hit 600. This is unprecedented. So Palantir at the moment is trading at 600 times its trailing annual profit. And it's trading at 88 price to sales. This number has never ever been achieved by a major company ever in history, even remotely close. The value of the company is 88 times their total annual revenue in 2024. The reason this is fascinating is because Palantir has now set a record for the most absurdly valued company in history. There has never been a large cap company that was valued even remotely close to these numbers ever in the history of the stock market. I know that in making this video, I will inevitably attract an army of Palantir fans spewing hate in the comments. That's what happens every time. I have not owned shares in Palantir for about 3 years, and I am sure there will be the obligatory comments about how I suck, how I'm sour, I missed out, how I'm salty and whatnot, but the simple fact is I just don't care. It is fascinating when you put the pieces together to see how Palantir got to this valuation. Palantir's projected revenue for 2025 is about $3.7 billion. Their net profit margin last year was 16%, but even assuming that that goes up to 20% in 2025, which would be higher than their best ever quarter, Palantir would have a net income of $0.7 billion. And it's interesting to go and compare Palantir to the fastest growing stocks in the last 30 years at the same point, at the same value, just to understand where does this valuation sit in comparison. Now, Apple reached a valuation of $250 billion in 2011. In 2011, their revenue was $108 billion, and their net income was $26 billion. And at that time, Apple sales were growing 66% year on year, while Palantir is projecting growth of 31% this year. Apple had just launched the iPhone, which was a completely revolutionary product. Sales were going absolutely bananas, but Apple's price to sales was 2 compared to 88 for Palantir today, and Apple's forward PE ratio was less than 10. Tesla is another interesting example because in 2020, Tesla's stock exploded after they launched the Model Y, and after all the new factories started producing, and at the same time, the whole stock market went completely crazy in general. And in 2020, Tesla also hit a valuation of $250 billion for the first time. 2020 was the year in which Tesla first broke even, so their profit was very small and roughly the same as what Palantir is expecting to achieve this year, $0.7 billion. But it is very common for companies that just break even for the very first time to have crazy PE ratios, because when you first break even, your profit is so incredibly close to zero. Palantir has been profitable since Q4 2022, so their profit margin is now a lot more mature. And Tesla's revenue in 2020 was $32 billion. So Tesla's price to sales in the year when the stock went absolutely nuts, the most crazy year for Tesla stock, maybe the most popular stock with retail investors of the last couple of decades, at the point when Tesla hit that $250 billion valuation, their forward price to sales was about 10 times lower than what Palantir is today. And Tesla was growing at 28% at that point, so roughly the same as what Palantir is projecting for this year. Now, a couple of other examples. Amazon hit the $250 billion mark in 2015 when their revenue was $107 billion and their profit was $0.6 billion. Again, the company was at break even at that point because they were intentionally not taking profits but reinvesting money back into the business. Amazon was growing at 20%. And that growth was rapidly accelerating at that point. Microsoft first hit a valuation of $250 billion in the dot-com bubble in 1998, 27 years ago. Back then, valuations went absolutely crazy, and Microsoft had revenue of $15 billion back in 1998, $15 billion, $1998, and a profit of $4.5 billion. And in 1998, Microsoft's revenue was also growing at 28%. Their price to sales was nuts. It was 20. And even then, at the end of 1999, when everything was absolutely off the charts, when Microsoft's valuation peaked and hit $600 billion, their forward price to sales at this most insane point was 26, which is still over 3 times lower than what Palantir's valuation is today. And Microsoft's forward PE ratio was about 100 in 1998, which was crazy, never seen before sort of territory, because it was the dot-com bubble, but it wasn't quite at 600. And their forward PE ratio actually went down to 60 in the 2 years after 1998 as the crash approached. Perhaps the best known example of a company that became insanely overvalued, the one that everyone cites, is Cisco. In the dot-com bubble, Cisco became the most valuable company in the world after its share price absolutely exploded. At the very peak of this crazy run, Cisco was valued at about $540 billion in March 2000. In the financial year ending July 2000, Cisco's revenue was $18.9 billion and their net income was $2.7 billion. So the company that is best known for being horrifically overvalued in the biggest bubble in stock market history, arguably, the dot-com bubble, had a price to sales ratio of 28 at the peak, at the very peak, and a price to equity ratio of 200. Both of these numbers roughly 3 times lower than the equivalent ratios that Palantir currently has. Palantir is a great company. Don't get me wrong, they offer great products, very useful. They serve the government, they serve many businesses to improve their use of their data. Looking at the numbers is not the same thing as being some kind of hater. I know it's hard for some people to acknowledge that, but the stock market is having this unprecedented AI-fueled boom. Any company that tells people that they are an AI company is immediately worth like 10 times the amount they were worth yesterday, and investors seem to not really care about the valuation or how you arrive at it. Just, shut up and take my money, because the conversation is all about the momentum. It's all about believing in the company, right? We are in this new paradigm in the world of investing where investors, including Wall Street investors, it seems, prefer to be in a fan club of a stock. Instead of being rational looking at the numbers, people want to be in this group of like-minded people. If somebody dares point out something maybe slightly negative, maybe something that goes against what you all stand for, something about the valuation or the performance, the automatic reaction at the moment is to mock, to hurl abuse, to name names, whatever, regardless of whether the points being made are valid. However you build your valuation models, the current valuation of Palantir would need to assume growth of something like 60% a year for the next 10 years straight to justify the price. But the response to this sort of point is that normal valuation approaches just don't apply. They don't work for Palantir. And if you disagree, then, well, you're an idiot. You're a dinosaur. You don't understand the future, bro. And when I was looking at Palantir's recent results, I saw something pretty interesting in the data. In the 10Q form that was filed in November 2024 for the previous quarter, there is this table showing the stock options that Palantir has outstanding. And on the right, there is this table for SARs. SARs are stock appreciation rights. It is similar to options. It's similar to having stock options, except in the case of an SAR, the employee never has to actually then buy the stock by paying the exercise price. Instead, the SAR just gets paid out in cash, or rarely in stock, but if the share price of the company goes up enough, the employee gets a sort of bonus payment. And there is a paragraph here under market vesting SARs. During the 9 months ended September 30th, 2024, the company granted market vesting SARs that vest upon the satisfaction of a market-based vesting condition and are subject to continued service. The market-based vesting condition is satisfied when the price per share of the company's Class A common stock exceeds $50 within an open trading window, measured based on the closing price of the immediately prior trading day. Following the satisfaction of such condition, market vesting SARs may only be exercised on and above price day. The maximum appreciation is up to $20 per market vesting SAR. So if the share price was to go above $50, then employees can pick up a nifty bonus for up to $20 above the $50, so up to a share price of 70. If it goes to 70, the SAR is maxed and you cash it in. And that's what's happened in Q4. These are market vesting SARs, but Palantir has also issued some time vesting SARs. During the 9 months ended September 30th, the company granted time vesting SARs which vest over explicit service periods of up to 9 years. Time vesting SARs have exercise prices of between $39 and $70 and maximum appreciation values of between $60 and $180. So the time vesting SARs, with them you have to wait. But in the Q4 report, Palantir said that their GAAP net income was $79 million. But because the stock went over 70, a lot of the SARs, the market ones, the market vesting ones, were cashed in. And the net income would have been $165 million without that. So those SAR awards added up to $86 million. But remember, there were about 50 million SARs outstanding as of the end of Q3. And even if you take the lower yielding one, the market vesting one, at a $20 upside, that's $1 billion worth of SAR value. So the cashing in that happened in Q4 was only a very small portion of these SARs. So calling the impact a one-off that only applied in Q4 is probably a little bit premature. It is pretty fascinating how these SARs were awarded for the very first time by Palantir at the start of the year. In fact, if you look at the Q1 report, almost all of the SARs were given out in Q1 when the share price was just $16. There were none at the top before Q1 started, and then almost all of them were added. And it's a pretty incredible, very, very lucky coincidence that they managed to dish out all of these unique versions of stock-based compensation that they never issued before, that rely on the stock price going up very quickly just before the stock went on the biggest bull run of any stock ever in stock market history. It's also fascinating that the company that has the highest valuation in history made 40% of its income last year from interest and only 60% of their income from operations, the actual thing the business does. And that interest is being earned on money that Palantir did not earn. It's money that Palantir made from selling shares to investors. Because on the balance sheet, you can see that the accumulated deficit for Palantir is minus $5 billion. It's negative. And that means that since the company was formed, they've actually, in total, cumulatively lost $5 billion. But then they also sold $10 billion worth of shares to investors. And the difference between these two is the $5 billion in stockholders' equity. And that's why when you look at the top of the balance sheet, you can see that Palantir has $2 billion worth in cash and another $3 billion in marketable securities earning that interest, the same $5 billion. So 40% of the money that Palantir is making, the profit at the moment, is coming from interest payments on money that they collected from their shareholders, because interest rates went up. And for a company that has just set an all-time record, by far, by a long margin in terms of valuation multiples, that really is something, because investors are paying 600 times that profit, never seen before. And almost half of that profit, for which they're paying a 600 times multiple, is interest income from the savings account. Now, I thought you'd find this interesting. Thank you so much for watching, and I'll see you later.